Welcome to The Explainer. Okay, let's just dive right in, because today we're unpacking one of the most fascinating market stories out there right now. We're looking at the incredible recent surge in Lincoln Educational Services. You probably know it by its ticker, LINC. Now, you might be thinking, an 80-year-old vocational school sounds like a sleepy stock, right? But honestly, the data we're about to look at tells a completely different, frankly, explosive story. Just to establish the stakes right off the bat, look at this, a 115.4% total shareholder return over the past year. Yeah, you heard that right. More than doubling your money. If you're an investor hunting for hidden momentum, that is a number that literally demands your attention. The market is aggressively pricing in a totally new reality for this company, and as analysts, we need to figure out exactly what's driving this massive wave of capital into the stock. So here's our roadmap for today. First, we'll look at Link's breakout quarter. Then we'll explore why this is actually an unlikely AI play. After that, we're digging into the hard financials, weighing the valuation debate, and finally, looking at the future outlook and risks. All right, part one, Link's breakout quarter. So the real turning point hit in mid-May. After dropping their Q1 2026 earnings, LINC saw this explosive 15.4% single-day jump, pushing the stock to an all-time high of $51.64. I mean, a single-day pop of that magnitude for an established education provider, that is incredibly rare. It's a huge signal that Wall Street is totally rethinking this company's earning power. And here's why it popped. Wall Street was expecting a pretty quiet quarter, just a penny per share. But Lincoln, they delivered 14 cents. They literally more than tripled the average analyst estimates. When a company shatters expectations like that, the market basically has no choice but to aggressively re-rate the stock, which is exactly what we saw happen. Moving on to part two, an unlikely AI play. Okay, check out this quote from a recent Motley Fool analysis. They called Lincoln a sneaky AI play. Now, I know what you're thinking. A company that runs physical campuses, teaching auto repair and skilled trades, what does that have to do with Silicon Valley and artificial intelligence? Well, there is a very real physical side to this digital revolution. Think about it. The tech sector poured nearly $1 trillion into AI data center construction just last year. But here's the catch. These massive computing hubs don't just build and cool themselves, right? Cooling thousands of those high-performance AI chips takes incredibly specialized, heavy-duty physical infrastructure. And that has triggered a massive, surging demand for skilled electricians and HVAC technicians. Lincoln's core training programs are perfectly positioned to pump out the exact workforce needed to build and maintain the physical backbone of this whole AI boom. Management even highlighted this specific demand on their earnings call, making LINC a super vital, albeit indirect, AI infrastructure play. All right, part three, digging into the financials. Let's see if the numbers actually back up the hype. Looking at Q1 2026, revenue jumped an impressive 22.5% to $144 million. But the real story is on the bottom line. That revenue growth translated into net income more than doubling, surging from $1.9 million all the way up to $4.4 million. And the engine behind all this? The students. New student starts climbed 19.5% to over 5,500. This is absolute proof that the macro demand we just talked about is translating directly into actual enrollments. And here is why that matters. This isn't just a lucky one-off quarter of great margins. The financial growth is backed by a really robust, expanding underlying student base. The total student ending population rose by 17.6% to over 18,700 students. For an analyst, that's beautiful because it gives the company excellent forward revenue visibility. Those students represent locked-in tuition for the whole duration of their programs over the next few quarters. Their operational efficiency is just as wild. Operating income expanded by a massive 87.7% year over year, hitting $6.4 million. This is a textbook example of operating leverage. Basically, as they fill these existing classrooms and programs, the extra cost of each new student is super low. So a huge chunk of that new revenue flows straight down to the operating profit line. Which brings us to part four, the valuation debate. So here is the multi-million-dollar question we need to answer. Is LINC overvalued after jumping over 115% in a single year? Or with these AI infrastructure tailwinds and expanding margins we just laid out, is it literally just getting started? Right now, analysts are staring at some very conflicting metrics, making this a fiercely debated stock. Let's look at the bear case first. Visually, the valuation is a bit alarming. The stock trades at a trailing price-to-earnings ratio of around 71 times. When the broader U.S. consumer services industry averages a PE of just 16.8, LINC looks really expensive, especially when you factor in the high execution risks of building new, costly physical campuses. But flip over to the bull case, and it's a totally different story. Using a discounted cash flow model, Simply Wall Stent calculates LINC's fair value at $69.37. With the stock currently hovering around $50, that DCF model suggests the company is actually about 16% undervalued. And that's driven by expectations of those expanding margins and the massive, unpriced demand from the AI infrastructure build-out.
So where do the pros actually land on this? Well, despite that optically high 71x PE multiple, the Wall Street consensus is overwhelmingly bullish. Out of 4 analysts tracked, 75% rated a strong buy, and the other 25% say buy. 0 holds, 0 sells. They've pegged a consensus price target of $54, basically saying that this operational momentum easily outweighs the high multiple premium.
Finally, Part 5, Future Outlook and Risks. Riding the high of that massive Q1 beat, management actually raised their guidance for the 2026 full year, and the numbers are incredibly strong. They bumped the revenue target up to between $590 and $600 million, and raised adjusted EBITDA to between $76 and $80 million. They're also projecting student start growth of 10 to 14%. And strategically, they're committing to opening 2 brand new campuses every single year to capture demand in underserved metro areas. That guidance tells us management is incredibly confident this operational momentum isn't stopping anytime soon. But we've got to ground this in reality, right? Opening 2 new campuses a year takes flawless execution and a lot of cash. Management expects CapEx to hit between $70 and $75 million for the year. If enrollment at those new campuses stalls out for any reason, that heavy capital drag could really squeeze those newly expanded margins. Plus, as an education provider, LINC is always subject to regulatory shifts in federal student funding. That's a structural risk you can just never entirely ignore. And that brings us to the ultimate question you have to ask yourself. As you weigh these rock-solid fundamentals against that rich valuation, what's the verdict? Will Lincoln's physical infrastructure training truly become the vital long-term backbone of the AI revolution, making that premium totally justified? Or is a 71x PE ratio just a bridge too far for a vocational school, no matter how perfectly positioned they are? It is such a fascinating tension, and it definitely makes LINC a financial story you're going to want to keep on your radar. Thanks for joining me for this explainer, and I'll catch you next time.